Good morning, everybody. This is Patrick MontesDeOca with the Equity Management Academy live trading room, live streaming from Ticket Talker. Turnaround Tuesday today. Let's take a look to see if that is in fact true here. Gold is trading last at 1839.70, up about 550. We've seen a reversion back from the sell one level of 1846 at about 6 a.m. this morning. And this has activated a short trigger actually on a daily pattern. And what has activated is the average price of 1827 below. So we've come down to Bollinger Band support. So we see a little bit of demand coming into this level of support, short covering. Basically, if you sold from 46, you're trading 39. That's a nice day trade. Let's take a look at some of the other markets here. The silver market, trading last at 27.4450, has reverted right from the weekly average that we made this morning at 27.77. It met the sell one level of 27.73, and it reverted, activating a short trigger daily and a weekly bearish trend momentum, and automatically the target below was completed. The daily mean of 27.33 was completed. So you're looking at the volatility in the market expanding, as I see, daily. From 73 to 33, that's a 40-cent drop in a matter of from 6 a.m. in a half hour, 40 cents. So if you shorted this, and by the way, we recommended our traders in our private trading room, basically, that they should cover their position and protect the equity gains that we've been making here this morning. And this was at 6:29 a.m. It's before the market opened. And also I, again, share a lot of this information prospectively because the VCPMI is a prospective algorithm that identifies for you the extreme levels of the supply and demand, which is basically the essence of what we're doing here. And within a Fibonacci structure of 5 levels here, it gives you the probability factors by identifying the colors. For the purposes of reverse engineering the algorithm for self-directed individuals, for people that are serious about trading, thinking outside of the box, this algorithm is a contrarian algorithm that identifies the extreme levels of the supply and demand to be traded for that day session, weekly, monthly, yearly, and so on. And we use long-term cycles as well, particularly the 9-year cycle, to see how the current pattern fits into the longer term picture. And what we try to identify basically is where are the mathematical probabilities where the algorithm identifies the extreme levels, which is where the highest probabilities are mathematically. Meaning, if you're trading in green, it doesn't really matter whether it's a day or weekly, it's the average price. And the average price has a standard deviation relative to the implied volatility to the mean of 50-50, which means that it can go either way for you as a trader. So when the price is trading in between the average price, it's real choppy, is basically what it's saying. And, it can go either way. As you can see here, trading on the weekly average earlier, the market came up to a high of 27.87. This was at about 2:15 a.m. And it completed the target. The daily completed the average weekly. And even though it activated a bullish trend momentum by this close above, it chopped around the average price until this signal activated a decisive short trigger. So what we had here today was a combination of the daily sell one level of 27.73 and the daily average price of 27.77. To those that are following the VCPMI, obviously this rings a bell. It should ring a bell, and it's called the harmonic alignment. Excuse me. The harmonic alignment is mathematically the highest probability where the algorithm expects a reversion to unfold. And upon completion of that target, it satisfies the previous pattern, completes the pattern, and it creates a high probability some of these things, particularly stream live stream. Well, I think we're back. And so the pattern was completed from the short trigger if you managed it with a trailing stop or managing your profits, but it did provides for you the target that you want to use to manage your position. So coming back here, I expected a reversion to unfold because we were getting a harmonic alignment here in 2773, 2777 was a very strong resistance level that most technical analysts would qualify this in. And so this relationship, again, it's a very optimal relationship where we can expect a reversion, and it did unfold. It completed the daily target, and the weekly target activated by the close below the average weekly, unless we close above 2777, the 2520 has been activated for the silver. And I think 2520 would be 2520 to 2336 has been activated for the rest of the week. So let's see how the silver market resolves this supply that seems to be coming up here as the day progresses. The same thing with the gold market here. It came right up into the sell one level that essentially corresponded with a Fibonacci 38.2 retracement. And we reverted first time around 1:45 a.m., 2:15 a.m., we began to see supply come into the market. At 6 a.m., we saw more supply come into the market, and the market activated a bearish short trigger at 1842.90. That signal brought you into a low of 1832.60. So that's almost $10 move that it gave you the opportunity on this trade, if you went short, to trail the position with a stop, lock it in, take a profit, a quick profit for day trade. For most people in the US, obviously the signals that come in on the Globex are a little bit difficult to trade them unless you have a Globex platform where you can execute them. So we are approaching what the algorithm calls distribution of supply. The numbers that we see here are 1846 to 1860, that it tells us this is the area that we can expect supply to come into the market, sellers to come into the market. We already are seeing that here a couple of times. So this level of 1846 obviously is a level to be challenged, and so far the buying going on here seems to be taking the supply out of the equation. But we want to see pretty much how the market reacts to this area. So in terms of trading, what this identifies basically is the short triggers from here, from a sell one level to the mean. There are 50-90% relative implied volatility to the mean, which means that if the algorithm activates the trigger point, that the reversion back down to the mean has a high probability mathematically. It's not a guarantee that it's going to go. Nothing is guaranteed in the market except the market itself. And what this algorithm does is it follows the market when it changes, whether it's in a short-term, intermediate or long-term signal. So this prepares you as a self-directed trader. As you can see, we're dealing with the math of the market, not the chatter or the noise. This prepares you to sell into this. The highest probability trade to be identified is by selling rallies into 1846. By selling rallies into 1860. And the weekly goes all the way up to 1866. This is a ceiling of resistance all the way up to 1874. So how do we handle this? Where do we go from here? What is the VCPMI identifying for me as a self-directed trader? And so what I've done here is I've hedged my position short term. And it's up to you, based on your profile and your account, how you do that, obviously, how you manage the risk. That is a choice that you make as a self-directed trader. But using the VCPMI as a GPS, excuse me. Now, this is beginning to tell me that I need to be cautious up here on these rallies, all the way up to 1874. Unless it closes above 1874. And these numbers are static, obviously, produced once a month, but I believe those numbers might be coming down. It could be coming down. So nevertheless, it tells you where the monthly average price is, or where the resistance to be challenged is, in order to move up into a bullish uptrend momentum, which activates the targets of 1917 1886. I'm sorry, 1866 is the sell one weekly. The monthly is 1874. The sell two weekly is all the way up to 1917. So we have to, again, buyers have to be a lot stronger than the sellers, that this is preparing us The 1825 is the weekly average. $17.75 is the buy one level weekly. And $17.34 is the buy two level weekly. So on the right, you see the information that is correct on the website and that I publish in my trading room. But I put it on here because I want to see how the price is relating to all of these signals together. The key to this rally was when the market came down below the below the annual average of 1810, and it came above it after testing the 1793 low. 1793 was, again, an area of accumulation of supply. The algorithm tells you this is where you can expect buyers to come in. And closing above the annual average of 1810 activated all these bullish signals, patterns, signals, and the momentum, the price momentum unfolded to complete the patterns above, as you can see. Going right through the weekly average of 1825. So we're back to testing this level here. And we want to test to see the strength of buying into this supply area. And in terms of, again, for myself, what I'm recommending here is, we've locked in some nice profits here from that 1800 level, basically, in the initial move that we had up to 1874. So we have a trading range, basically, of about 1800 around the 1800 level to the 1874. And you can see on the daily here, this looks a bit busy here for most of you guys, but I use this and it identifies all of the different indicators and where they are in relation to each other. So I think there is, in terms of wave count, possibly another wave down coming. This is a wave 1, 2, 3, and wave 4. We're right up against this wall of resistance. So unless truly we break decisively above 1874, you're going to experience some supply issues here. And we want to see how the strength of the buy-in underneath relates to the supply. So far, you can see even coming down into this lower end of the Bollinger Band, right into that 1793 by 2 level. The monthly level is below 1781. The buy 1 weekly was 1775. You know, we found buyers earlier, you know, close to that 1785 level seems to be the number that we want to watch. And if we cannot get through this supply here, then this could be the fifth leg, the bottom, that may bring us down into this level here. Again, into that low 1800 or under 1800. Before the spring rally begins, I believe. So we want to be cautious up here now. We've been very bullish here all this time. Obviously, if you look at my videos, you know, but we've stalled out here, and that's telling us something. That's resistance. So we're comfortable hedged at this point, and you know, we'll wait to see what the market wants to do here. We are getting signals, reverting signals. So we'll watch the market here carefully. We took some nice profits this morning. The monthly average is 1874. If I said 1847, I made a mistake. It's 1874, the monthly average. Let's continue to observe the trading that is going on up here at 1846, and it's activated once again, another short trigger by closing here below. So on the daily, we seem to be entering again into some kind of a selling or pressure from these levels. On this bar, it went, it activated a setup here. By touching the first time this level, it activates a trend alert. And the close below on the next bar close, the conservative is to wait. So this bar ended at 7:30. At 7:45, a conservative entry point would be to wait for the close below again at 1846. So this is a double confirmation that we would get if we close below 1846 at 7:45, and that would activate a short trigger. And that is written in C++ coding and is automated in TradeStation. What I'm teaching you is the reverse engineering AI that goes into the algorithm. So at 7:45, if we get a close below 1846, it's going to activate another short trigger. This would be the third time today. The gold market is trading on its own technicals, and it is not following the fundamental picture that we have, or the pretty much complete picture, which includes the political picture, the economics, the pandemic, and the monetary system. The argument that just seems to be politicized again is, how much money is going to be coming out as stimulus. And they're talking about this $1.9 billion package here that has been pretty much factored into the market. The market has a way of digesting that information and reflects on the price movement. And everybody, as we came in to the this new year, this new administration, had very high hopes that the Biden administration is going to come in aggressively and provide a large amount of stimulus, quantitative easing. And according to some of the recent commentaries that you see on the internet or on CNBC, there is a school of thought that thinks that the economy does not require the stimulus. Some economic indicators, obviously, off the bottom of the barrel are moving up and indicating, some activity, some growth, but you're not getting a macro economic growth picture that will change the dynamics of this tremendous collapse that we saw. We're far from the levels that we were prior to the pandemic. Everywhere you go, small businesses, mom and pop businesses are suffering. There are some businesses some people that I talk to, that they haven't for a year received any revenue. Landlords, particularly of those mom and pop businesses, which are not wealthy real estate investors, they're average people trying to make a living, simply that they were in a position to buy a piece of property and lease it out and rent it and generate some income. But they still have a mortgage to deal with as well. So if the renter does not pay rent, how does the landlord going to justify the mortgage if there's no income coming in? So it precipitates a really bad chain effect that can be catastrophic, obviously, if things do not change, if we do not get some kind of support financially from the government. There is no question that there is no other time in the history of this country, or this world for that matter, that this is more critical than ever before. And I think one of the elements that have kept the market from collapsing here is the fact that they have agreed to providing large amounts of stimulus. But I think the problem that we're dealing with is that the damage was a lot deeper than the talk. And the longer they keep this uncertainty going with regards to how much and when and who gets it, things are going to get worse. So I think there is an urgency to move quick, to move fast in providing this stimulus to Main Street. There's a lot of suffering going on right now, and I think this is one time that the government really has to make a difference. But in the meantime, the gold market is trading on its own technicals. It's contrary to the fundamentals. And so what you'll see is that when the sentiment in the market becomes bullish, the market usually will do the opposite. Point in case, back in August of last year, 2089, pretty much everybody was bullish in the gold market, was, going to 5,000, 10,000. And we reverted from 2089 all the way down to 1867 last year. And we're back up again trading in that 1840-50 level. I think the gold market is lagging in price discovery. I think the silver market is gaining momentum, notoriety. It is the cheapest asset across the board. So we're beginning to see a lot of interest developing in the silver market because it's not only an economic indicator or poor man's money, as they say, but it is the real pulse of the silver market in terms of the fundamental application in industry, technology, solar panning that's going on right now with this new awakening, you might say, in technology. I think one of the key factors that we want to watch in the silver market, I think that could ignite a fantastic rally, is the ability for the, you might say, companies that use a lot of silver, companies like Apple, technological companies, particularly that are into creating high sophisticated chips. The application of silver is substantial in the cash market. They do it quietly. They do not want the price of silver, particularly in the cash market, to have any issues because it would create problems for their production and manufacturing of their products. iPhones, computers, batteries, solar panels. And I believe that we are on the cusp of not only activating the retail demand that I think it will be historic in its nature by the proportion, you might say, of buyers that are available in the market now, if you take into account particularly this millennial energy, the Reddit group. The thing that would ignite, I believe, this tremendous explosion in silver would be if we begin to see pressure put on the 1,000 bars in silver, which is the industrial cash size that basically determines the demand strength or weakness that we have industrial from the industrial demand area. And so that is a key that will determine, obviously, if we get panic buying, thinking that we're going to have shortages of cash, which in fact we do have. If you check out the cash market right now in silver and gold, either you got to wait a long time for you to get it, or you got to pay, or you got to do both, pay a high premium and wait a long time to get it. And in some cases, I hear a premium up to a 50% took place here just a week ago in silver. It saturated the cash market. We have a problem getting physical. And so if we have a problem getting the physical market and the only place to go is in the futures markets with this massive short position by central bankers, so-called category, the short side of the market should be nervous. This could be an awakening like we have never seen before in the price of silver. We could be at $50 pretty fast. So I'm focusing my attention in silver because there seems to be a rumble going on in the silver market that potentially we are running into some major shortages. And if that is the case, we could be at $50 silver in no time. But once again, the market never goes when you want it to, or when the majority or the herd out there is calling for silver to go, as opposed to possibly, since this information is already factored into the price, which is tremendously bullish, by the way. It wouldn't surprise me to see a reversion of price to unfold from this level again that we are looking at in resistance at 27.73, 28.10 in silver. Potentially could revert back all the way down to 24.18. A good solid $3 move. So I think the market is obviously trying to find its value, its mean in relation to the fundamentals that we're dealing with right now, economically, politically. So it's an interesting market. It's a thin market, but I think it's going to be an explosive market. You can see back into the gold market here that the resistance of 1846 has activated a short trigger. On the close at 43.30. It got up to that 46 level, and it reverted. As you can see now, we're beginning to see some selling unfold. So if you wanted to go short in the futures markets here, the signal was to go short at 43.30. The stop would be 46. The closest stop would be 46. We short the futures at 1843.30. This gives you 3 levels of stops for you to use. You can use the close above 1846, which is the level below, as your most conservative stop. You can use a maximum dollar amount based on your profile, or you can wait till the end of the day, the close till the end of the day, to execute the position as a day trade. So you have 3 choices of stop. I personally use a hard dollar stop, and as soon as the position begins to work in my favor, I begin to trail the position with a stop. After maybe $200-300 gain in open trade equity, maybe you can bring your initial your initial protective level to break even if you want to maintain the long-term bias of the signal all the way to the next target. And that would be 1827. That would be the target for today. And right underneath is 1825, which is the weekly average price. So we've taken a short at 27.4650. This is a high risk trade. The gold market activated a short trigger from 1846. So we're short at 1842.30. And your target automatically is the level below. The initial one is 1827. The larger one is the weekly 1825. And you got the Bollinger Band, the lower level at 38.50. I recommend if you have $300 on the first contract, if you're doing multiples, that's a good place for you to unload some of the profits here. So that would be a good place. $41.70 last. So you, if you enter 43.30, you obviously can begin to work that stop in your favor as the market begins to move in your direction. 41.60 traded last. for the time being, use the rallies into that 1874 to unload some of the profits if you are long here. And if you're trading short term, obviously we're short the daily. 1846 is our protective level, or as the price begins to come down towards our targets, then you can begin to use your judgment in terms of the profit levels that you can take. If you're doing multiples, protect some of the profits, as I said, by pulling out the initial first $300, and then you can let the rest go. But if you took this trade, I want to wish you good luck. Hold on to your objective. Do not change any core, positions that we have, any recommendations that we have. We are simply looking for a short-term counter-trend correction. Good luck. I'll talk to you soon.
The risk of loss in trading commodity interests can be substantial. You should therefore carefully consider whether such trading is suitable for you in light of your financial condition, and considering whether to trade or to authorize someone else to trade for you. Past performance is not necessarily indicative of future results.
Hi, I'm Stephen Kalajian. I've been trading for over 35 years. My specialty is day trading the market.